Hello guys, welcome back to my channel Scapital Investments. My name is Salman Shaikh and you're watching Basics of Futures Trading Part 4. Within the Indian derivatives world, the Nifty Futures has a very special place. The Nifty Futures is the most widely traded futures contract in India and also across the world. This also makes Nifty Futures the most liquid contract. Once you get comfortable with Nifty Futures, then like many of us, you would also be trading frequently in the Nifty Futures contract. For this reason, it would make sense to understand the Nifty Futures thoroughly. However, before we move forward, I'd like to refresh your memory on our previous videos and the topics that I covered earlier. So in the part 1 of a futures trading video, we introduced the futures trading as an evolution to the forwards market. In the part 2, we discussed how we can use the leverage inherent in the futures trading to build our capital. In the part 3, we discussed how we can short the Nifty futures and hold it for a few days or probably even a month. In case you haven't checked out those videos, I'll leave a link in the description for the complete playlist. Please do check it out for the better understanding of this video.
I assume you are comfortable with the basic understanding of the index, that is, the composition of multiple stocks. Therefore, I will proceed to discuss the index futures, or specifically the Nifty futures. As we know, the futures instrument is a derivative contract that derives its value from an underlying asset. In the context of Nifty futures, the underlying is the index itself. Hence, the Nifty futures derives its value from the Nifty Index. This means if the value of the Nifty Index goes up, then the value of the Nifty futures also goes up. Likewise, if the value of Nifty Index declines, so would the index futures. Now here is a snapshot of Nifty futures contract. I shown this to you exactly from the NSE terminal. So like any other futures contract, Nifty futures is also available in three variants: current month, mid-month, and far month. One of the main features of Nifty futures that makes it so popular is its liquidity. Now let us proceed to understand why does it make sense to trade in Nifty futures. So as you know, the Nifty Index is a basket of 50 stocks. These stocks are selected to represent a wide section of Indian economic sectors. This makes Nifty a good representative of the broader economic activity in India. This naturally means if the general economic activity is going up or at least expected to go up, then Nifty's value also goes up and vice versa. This also makes trading Nifty futures a much better choice as compared to single stock futures. There are many reasons for this, and here are some. First, it is diversified. At times, taking a directional call on a single stock can be a tough task. This is mainly from the risk perspective. For example, let us just say I decide to buy Infosys Limited with the hope that the quarterly results would be good. In case the results don't impress the markets, then obviously the stock would take a knock and so would my P&L. Nifty Futures, on the other hand, has a diversified portfolio of 50 stocks. As it is a portfolio of stocks, the movement of the index does not really depend on a single stock. Of course, occasionally a few stocks, that is the index heavyweights, can influence Nifty to some extent, but not on an everyday basis. In other words, when you trade Nifty futures, you completely eliminate unsystematic risk and deal only with systematic risk. I know these are new jargons being introduced here, but we will discuss these terms in more detail at a later stage when we talk about hedging. The second point here is that it is hard to manipulate. The movement in Nifty is response to the collective movement in the top 50 companies in India by market capitalization. Hence, there is virtually no scope to manipulate the Nifty index. However, the same cannot be said about individual stocks. Remember the Satyam scam or DHCL or Bhushan Steel, etc. The third point here is that it's highly liquid. Easy fills, less slippage. We discussed liquidity earlier in the chapter. Since the Nifty is so highly liquid, you can literally transact any quantity of Nifty without worrying about losing money on the impact cost. Fourth point here is the lesser margins. Nifty futures require much lesser margins as compared to individual stock futures. To give you perspective, Nifty's margin requirement varies between 12 to 15%. However, individual stock margins can go as high as 45 to 60%. Fifth point is the broader economic call. Trading in Nifty futures requires one to take a broad-based economic call rather than company-specific directional calls. From my experience, doing the former is much easier than doing the latter. Sixth is the application of technical analysis. Technical analysis works best on liquid instruments. Liquid stocks are hard to manipulate, hence, they usually move based on the demand supply dynamics of the market, which obviously is what a technical analyst mainly relies on. Seventh point here is that it's less volatile. So Nifty futures are less volatile compared to individual stock futures. To give you perspective, the Nifty futures has an annualized volatility of around 16 to 17%, whereas individual stocks like say Infosys have annualized volatility of upwards of 30%. There is something called as a round trip trade, and a round trip trade is an arbitrary, quick, instantaneous trade which involves buying at the best available sell price and selling at the best available buy price. And a round trip trade always results in a loss. And the impact cost measures the loss of a round trip trade as a percentage of average of bid and ask. So, higher the impact cost, lesser the liquidity, and vice versa.
So the key takeaways from this video of Nifty Futures discussion is that Nifty Futures derives its value from the underlying, that is the Nifty 50 index in the spot market. And at present, the Nifty 50 futures has a lot size of 50. The Nifty futures is also one of the most liquid contracts in India and even across the world. And just like other futures contracts, Nifty futures is also available in the current month, next month and the far month. Higher the impact cost, lesser is the liquidity, and vice versa. So when the impact cost will be high, then the liquidity will reduce. When you place a market order to transact, you may lose some money due to the impact cost. Nifty has an impact cost of 0.0082% and hence it is the most liquid contract to trade with the lowest impact cost. So friends, I hope you have understood the Nifty futures, and I'm pretty sure most of you will also be trading in Nifty futures. Although do remember that trading in Nifty futures is highly risky because it is a highly leveraged trade. So in the next video, I will explain hedging in futures. So in case you like the video, do hit the like button, and in case you feel you're getting knowledge from my channel, do subscribe to my channel and hit the bell icon. See you in next video. Until then, bella ciao.